Well, hello and welcome to our 2025 Dairy Goat webinar series. My name is Jennifer Bentley, and I work as an ISU Extension and Outreach Dairy Field Specialist housed in Northeast Iowa. And for many of you, you may have been on our webinar series the past couple years, and we're excited to be offering it again this year with the support of a Sustainable Agricultural Systems Grant, which in the next couple of months and actually in the next couple of years, you're going to be learning more about this project and the work that we're going to be doing with the dairy goat research and education outreach. So as a reminder, we do have another webinar coming up on February 5th, talking about care of neonatal goats with Dr. Rachel Frederick with ISU College of Veterinary Medicine. So that'll be coming up. I do want to note that these webinars are recorded. So if you want to go back and listen to them, I'll do a follow-up email with you all once it's recorded and put into our YouTube channel there. So you'll be able to watch it again. We are also able to offer this as a continuing education credit through ARPIS. So if you are members of that program or membership, you can submit those for ARPIS credits in that membership. So today's webinar, we're excited to have Dr. Larry Tranel, Dairy Field Specialist with Iowa State University Extension and Outreach, fellow dairy colleague of mine. Larry grew up on a Wisconsin dairy farm, majored in ag economics and international studies with masters in ag industries, all from UW-Platteville. And he spent 10 years as a dairy farm management agent with UW Extension and the past 25 years with ISU Extension and Outreach as a dairy field specialist, offering farmers a wide range of key areas of interest, including business and financial management, grazing and pasture systems, buildings and facilities, milking systems, dairy goats, and small and beginning farmers. So thanks for joining us, and take it away, Larry.
Yeah, I appreciate that, Jen. Yeah, I guess after 35 years of a career, you've pretty much done it all in a lot of respects. So yeah, we're going to talk about dairy goat profit analysis. So I used to be a dairy goat producer, just so you know. When I take a look at the thought process of how do you process the information that you have to try to do a financial analysis, it's a lot simpler than I think a lot of people make it to believe. And so when we take a look at the dairy goat, just what we're going to go through today, one of the biggest things is just kind of how do you figure out profits, and then we'll kind of relate it to the dairy goat industry, no doubt. So when we take a look at, my screen is not going down. So Jen, my screen is not advancing. There we go.
Okay. Yep.
So we're going to start with some of the studies that we did in 2023. I didn't realize that there was actually a goat island in the United States. It's at Niagara Falls State Park. So, of course, I had to bike it, being a goat producer. But when you take a look at the Wisconsin study, I just want to mention that it was supported by Compeer Financial and the Quality Dairy Goat Producers Co-op there in Wisconsin. So if you take a look at that study, actually quite a bit, because that's probably the most in-depth study we've done to date. So we've also presented this in different places, in Orange City, in Kelowna. I was out in Buffalo, New York, presenting to the American Cheese Society. And people were asking, why was the American Cheese Society so interested in this? Is because they're looking for goat milk. And when you take a look at especially on both coasts and what we have here in the Midwest, they're definitely looking at the kind of a shortage of goat milk. The pet food industry is taking some of the goat milk, just how do they supply it and try to keep producers in business. And so there's more than just us in Extension. The industry itself is looking at this, I think, pretty hard. And we also presented this at the American Dairy Goat Association convention there in Lake Geneva in Wisconsin there in October of this past year. So the first thing we're going to do is take a look at just how you take a little peek at the studies themselves. And so when we take a look at the groupings that we have, so just so you know that when we take a look at Group A, this is all 20 producers. The Wisconsin study was 20 producers. The Iowa study was only 3 producers. Next year, we're going to be traveling the country to California, Southwest, the southern part of the USA, and Texas, Oklahoma. We're also going to be doing studies in Wisconsin, Iowa, and maybe some other states as well. And so when you take a look at the Wisconsin one, we just did 20 producers. So Group A is all 20 producers. When you see that data, and I think Jen is going to put some of the handouts in the chat box or some way that you can get a hold of them. Group B is 6 producers, which I call had positive profits. And again, realize people have a different way of how they define profitability. Group C is 5 producers who, did okay, but they didn't cover all their labor costs or all their equity costs. Group D was 4 producers that had high financial risk that I'll actually be maybe surprised if they're still in business here in the next 3 to 5 years, just because of the financial risks that they're under. And then Group E was 5 producers that were hand milking. They were um, um, Amish farms that had to take their milk to a receiving station. And that was about a $9,000 cost on each one of the farms each year just to work with that. So that's just kind of a little bit of peek of it. So we also realized that we had 2 of the producers that milked in side by side. So I think a lot of times people think, to be big and profitable is the big thing. You got to be milking these rotary parlors and things like that. And I say that's not so, because a lot of these producers can get some very efficient side by side swing type parlors that are actually quite labor efficient. Okay, so it doesn't have to be the rotaries. We also realize that size isn't always what people think it is. Our Iowa producers, all 3 of them, were actually quite profitable, and they're milking 150 to 200 does for the most part, so not large operations. The second most profitable farm that was in the Wisconsin study was milking 120 does or less. And we also had, when you take a look at, did somebody have a question? So when we also take a look at, milk production per doe as being kind of the big thing, that you have to have these high production averages. We actually had one of the farms in the high profit group that had less than 1,400 pounds of milk sold per doe. So realize that the higher producing farms can be in the lower profit group. The bigger farms can be in the low profit group. And this, you can always see it, even though there might be a tendency for bigger is better. I tend to say that it's not always so. So we also had some of the farms that fed TMRs. The 2 of the top 2 high profit farms actually fed TMR. One was also doing processed baleage. And so we take a look at, the dairy goat industry, kind of like the dairy cows. We need to sometimes process this feed to get better intakes, to get more milk and things like that. One of the things that I was probably the most disappointed in visiting a lot of these farms was the facilities. And there's a lot of farms out there. It just seems like the ventilation, especially, is very subpar, whether it's where they're raising their young stock or where their milking does actually are. And what I think is probably the highest profitable farm was actually a wind tunnel situation, just very good ventilation, and just really didn't mind spending the money on the ventilation and actually having some very good facilities. And like the dairy cow industry, I tend to say that good facilities tend to pay for themselves. New facilities actually pay for themselves over time. And so whatever you can do to keep the dry matter intakes up, to keep the goats comfortable, especially in the milking phase, but transition does, and also when you take a look at the young stock and things like that, I mean, they need their ventilation with it as well. When we take a look at some of the farms, just the feed wastage, I guess is one thing I was kind of, thinking about a little bit, that, some of these farms that really made their goats kind of clean up the feed bunk. We don't do that with dairy cows. We try to find someplace else. They go to the heifers, or there's quite a few dairy goat operations that raise the steer too, where all that wasted feed could go to another class of animal, versus just call that all that feed wastage, and put that in as a big cost. And so the feed purchase tendency was another thing. It just seemed like the more the farmers tended to purchase more of their feeds versus raise it. It wasn't true in all of them, but I think there was a tendency that was the higher profits tended to purchase more of their feeds. And if you have any questions as we're going through this, feel free to just to ask them. I don't mind getting interrupted with it either. So the first thing is, how do you know if you're making money milking goats? Every dairy farmer, whether it be cows or goats, we think of our finances a little bit different, of what profitability is and what cash flow is, and a couple of different things. And so Jen's got a couple questions that she's going to pop up here in the poll. I wouldn't mind if you try to answer those before we move on too much further.
All right, thanks, Larry. I'm going to launch 2 questions here, and you should see them on your screen. If you wouldn't mind, if you are able to go ahead and select those. Question 1 is, if a farm cash flows, then it is profitable. And we want you to answer true or false. And then the second question, total cost of production per hundredweight equivalent need not include an owned asset charge or unpaid labor charge. And again, true or false question here. So go ahead and select your um, answers there, and we'll give you a few more seconds to respond. Looks like we have close to 30 participants on here today, and appreciate those who have put in where they're from in the chat. Looks like we have a wide range of where people are listening into today, Larry.
Yeah, without a doubt. So always appreciate the just getting producers from all over the country. Sometimes we get them international that attend these, and we learn from them as much as they probably learn from us. So it's good to have them.
So it kind of looks
So
like majority have voted. So I'm going to end the poll and share that out here, Larry, so you can see that.
yeah. Yeah,
So
I
it
think
looks
that's an important piece. So that first one, Jen, with does the farm cash flow, then is it profitable? Sometimes it is, sometimes it isn't. But the tendency is that it doesn't have to be true. We see a lot of farms out here that tend to cash flow quite well, but they're not profitable farms. And sometimes we see profitable farms that just can't cash flow. And I think part of it sometimes just the definition, and sometimes lenders and other people as well, they kind of mix up those two definitions. And so we're going to try to delineate the difference between cash flow and profitability with it. And then the second one, Jen, that's always kind of one that costs their production is that, people talk about their cost, their production. They say they're making this so much per cow or per doe. And it's just without taking a look at that equity and what's all being invested in that farm and how much labor is being, whether you get paid or not for it, it still has a cost because you could be doing something else. And so, yeah, both the answers to both these should actually be false. So appreciate that. So as we move down through this, and again, my thing is not working here. There we go. So what we're going to do with this session is we're going to take a look at the Ontario study. I may have shared this in a previous webinar, but I think there's some new lights that I want mine to shed upon that as we've got more of our information from our studies now as well. And again, I mentioned the Wisconsin, the Iowa financial studies. Vermont also did kind of a key study of findings. It wasn't a financial one, but they interviewed a lot of dairy goat producers just on their thought processes, their management and stuff like that. And as we go through the analysis, I'll kind of show you what the Dairy Goat Trans financial analysis actually shows and how you would actually do a financial analysis. And then we'll also take a look at just bottom line, just the profitability of goats in the future, the next steps of what the industry might want to take a look at or what you might want to take a look at on your own farm. So this is the Canadian study. It was done in 2019, 20, and 21. So COVID kind of hit us in that 2020 phase. So when you take a look at the blue is actually the cash costs, and you can see what producer labor is. And I think that was probably the biggest thing that kind of surprised me when you take a look at the financial analysis of that, is that their cash costs on labor are so darn high compared to what I would expect in a dairy cow or a dairy goat operation. And if we take a look at in that red bar where I kind of changed the numbers into US dollars of what their production costs would be on a per doe basis, and we take a look at what Wisconsin and the Iowa average down on the right-hand side there, and we think about what inflation has been, when you start taking a look at adding up 2 or 3 years of, 8, 10, 12% inflation, to have those numbers that much different than what we are seeing in about $1,200 costs on ours is not that far fetched. And so I think the big thing with the Canadian study in difference with ours is going to be basically those labor costs, which being quite a bit higher. And I'll show a couple more slides what that might mean. So we take a look at total cost of production on a per hundredweight or per hundredweight equivalent. If I change theirs into US dollars, again, you'll see that 42.20, 40.65, 39.75. So pretty, I think, good in line with what our production costs are here in the United States, in that 42.69 in 2023 for Iowa, and that 43.16 for Wisconsin in 2023. So again, those industries I don't think are that much different as we take a look at some of the things that they're doing in Canada compared to what we're doing in Wisconsin and Iowa. So this is a slide that kind of takes a look at their study and actually kind of breaks down the percentage. And so again, the biggest one that I just was really surprised with is how much their producer labor is. When you start taking a look at the 32% of their labor or their total costs go into labor. which I think is just astronomical. So if we take a look at what we might have here in the United States, if I have a dairy or dairy goat farm that starts pushing 20, 22% of labor costs as a percent of total cost, I tend to say we need to do something here because this is a very labor inefficient operation. And yet they're here, actually almost about a third of their costs are going into labor. So because labor is so high, I tend to say their feed is so low. Okay, so if you have labor that high, it's going to reduce the percentage of what's going into feed. And so in Iowa, Wisconsin, about 50% of our costs tend to be in that feed. And so on any kind of a typical cow dairy, it's going to be anywhere from 45, maybe up to 60%. And so that 50% is actually quite average, whether you're milking cows or goats, but that's kind of where that industry would actually stand. And if we took a look at these feeds in here and how much is purchased feed versus the homegrown feeds. Again, they're growing about, say 9-10% of their total feeds. And I think that's probably what we're doing a lot of it here. And again, there was kind of a tendency that the more feed you purchase, the more profitable your farm was. And so whether it's because of they're able to produce higher quality feeds or what they're able to do, but that's kind of just something I would kind of pick out from the data. So when we take a look at the total cost of dairy goat production, there's a lot of numbers on this one. There's a lot of numbers on all my slides. I apologize for that. And when we take a look at just the hundredweight sold per FTE, and an FTE is about 3,000 hours of labor worked annually. So it's called a full-time equivalent FTE. And so when we take a look at the Canadian ones in 2019, you can see that they're actually getting about 400,000 pounds of milk, or about 4,000 hundredweights per FTE. And so if I was going to put, just kind of a goal, for you to go back into your operation and look at if you as a dairy goat producer can produce 4,000 pounds of milk per doe or per FTE, sorry, annually per 3,000 hours, I would tend to say you're probably going to have a pretty profitable operation. And so that's one of the biggest benchmarks that I tend to see that I would like to instill in the minds of a lot of dairy goat producers is that because we have a lot that might only be getting 100,000 or 150,000 and they're expecting to, pay for their family living expenses and things like that. Okay, so sometimes you're probably not even getting minimum wage and you're probably even lower than minimum wage milk and goats. And so unless you can catch some of these benchmarks, I think it's going to be difficult for us to actually kind of say that there's profitability in milk and goats. Okay, so that's the number one benchmark I tend to say is 400,000 pounds per FTE annually. And I'm going to put the money where my mouth is on this one. I'm saying it's probably as or maybe even more important than milk production per doe. Not saying that's not important, but we'll get to that a little bit later. Okay, so now as we take a look at the average herd size, so now we have our groups up on top here. So Group A, again, is all 20 of them. Group B is kind of the high profit group, that's why it's kind of in the green. The Group C is kind of in the middle of the road. Group D is kind of the high financial risk group. And Group E, again, is the bucket milkers that are paying a lot of money for the receiving station and things like that. And then the far right, I tried to put the Iowa average of just those three farms across there. So our biggest comparison is probably going to be to try to look at Group B versus the Iowa average of those three. So you can see the herd sizes. And so, yeah, there was a tendency that those larger herds did tend to make their way into the high profit group. But again, it wasn't always so because of some of those small ones. And even the Iowa ones would actually kind of prove that a little bit different. Their average was only 154 does per farm. And yet all three of those are probably as or more profitable than our highest profit group in Wisconsin. So when you take a look at the assets, I think one of the biggest things when you take a look at this on a per doe basis is that Group 4, why are they in a financial risk? Is because they've got almost $5,000, $4,807 per doe invested in that farm. And so whether that be land, equipment, facilities, or whatever it is, it's just tough to make the does pay for that much in the way of assets. Okay, so 3,000 I think is a pretty good benchmark, and that's kind of where the high profit group actually went. So the hundredweights of milk, we'll come back to that one a little bit later, but you can kind of see if you just move the decimal point to places there about how many pounds of milk that they were getting on a per doe basis with it as well. So milk sales, you can see that the Iowa group actually had a little bit higher in the milk sales. There was probably maybe $3,000 per farm more in milk sales just because they had a higher milk price, it seemed, than the Wisconsin group had. But the other things that come into this, there was some Caldo sale issue when we take a look at some of the other income on the, yeah, if you look down at the other income on the far right at $72 per doe, is that there was one of those three farmers. And because I only had three farms, I couldn't really take one out. But they just did a very nice job of selling some does and actually buying back in some does. That was actually kind of a profitable transaction that kind of played into their analysis as well. So their total cash income, again, quite a bit higher on the Iowa side versus even the high profit group that we had in the Wisconsin side. So we already talked about the ending assets. We talked about the milk sales, but again, that cash income, and it's very difficult to say who's more profitable here at the cash income stage because that's pretty early in the financial analysis. So for those that have listened to me before, I was kind of liking it's kind of like even not even to the first quarter of the basketball game. You don't know who's got a clue here, who's gonna win. So when you take a look at some of the expenses, I'm not going to take the time to go through too many of these, but you can kind of see what vet expense and breeding fees. We did see quite a bit. And I think I'll just kind of mention this. We saw this at the American Dairy Goat Association meeting. People are trading, semen straws from one canister to another. I couldn't believe just how far they're taking these straws out, how long they're allowing these straws out of their one semen tank before it gets put into another semen tank. When they're taking a look at different types of things. And so that if you're going to be using I just think there's a lot of value to understand how important it is to properly handle semen, because I saw a lot of semen that was not properly handled there as they made the switch, and you're paying big bucks for it sometimes too. So feed purchased, you'll see the Iowa ones at 713, so quite a bit higher than the other ones. So most of there was still some land that they would maybe produce a little bit of hay, but for the most part, they were purchasing most of the feed on that one as well. The other thing, so the total cash expenses on the Group E at that 173, that's going to come from that $9,000 per farm. That's actually going into that receiving station with it as well. And so we come down to that net cash income. So you can see that the Iowa ones had 413, the top profit ones in Wisconsin at 301 per doe. Now Group E, this is going to be kind of an interesting one, and this is why we kind of go through the full financial analysis, because if you don't take into account the equity charge of assets that you own, that is kind of a cost of doing business or paying yourself for your labor, it's very difficult for you to compare your farm to somebody else's. And so this is where I would actually say on this net cash income, this is after the first quarter of the basketball game. It looks like Group E is going to win this thing from the Wisconsin data, but I can almost guarantee you that they're probably going to be the least profitable group, even though they have the highest net cash income. So from that net cash income, we look at an inventory change. And so sometimes, in a goat operation, you might buy a bunch of feed on December 31st. You have it on inventory there, but you really didn't feed it. Or it could be coming after the fact on January 10th or whatever. So these feed inventory changes, you could have, another 50 does at the end of the year that you didn't have at the beginning of the year, just because you raised a lot more does and stuff like that. So there's a lot of things that happen inventory wise, or sometimes we pay for a feed bill in December, but we don't use that feed until like January, February, March. Okay, so if we don't try to account those inventory changes, it's very difficult to do a financial analysis. In fact, it's actually quite misleading. And so that inventory change is a pretty important piece of the puzzle as well. And so when we take a look at that inventory change is negative in most of them, not a big difference from one farm to the next. But after that inventory change, we come up with that net farm income. So now we look at net farm income, and we'd still, from the Wisconsin side, we're still going to say, well, Group E is going to be our most profitable group. And I'm here to tell you that's kind of like halftime of the basketball game. You really don't have a clue yet, because there's still a lot of costs that haven't been accounted for. And so when we take a look at the next stage of that, which is going to be kind of take a look at that equity. So after that equity, so when I do this financial analysis, if you have bank debts, I don't even include those. Okay, so the interest charge. So I don't care if the bank owns these assets or you own these assets. There's a cost of doing business. It might be 5%, it might be 7%, it might be higher and lower than that, but you've got a cost of doing business. And so that has to come from it. And so a lot of people include sometimes their interest charge, but they, don't include what they actually have in their business. That could be assets that, they could sell that asset and they could invest in the stock market, the bond market, CDs or whatever, and it might earn 5 to 7% as well. And so that's the cost of doing business. This money and this investment has a cost. And so that's going to come out as an equity charge. And typically when we're doing these, we'll take out 3 to 4% of an equity charge. Sometimes it's land, and we realize that land, appreciates over time. And so sometimes we might not take the full charge against the land because we're getting maybe that 2 to 3% benefit over inflation with that. And so once we take out that equity charge, then we come up with return to labor. So that return to labor then is going to be the end of the third quarter of the basketball game. We still don't know if we won or if we lost. And so that return to labor, we don't know if it has to go over 4 people. Does it have to go over 1 person? It might have to go over 10 people. Okay, so that return to labor is important for us to divide either per an FTE of 3,000 hours or do it per labor hour, which I tend to do because it's a lot easier, it seems, to compare it to the labor market when we do it on a per hour basis, because we know what minimum wage tends to be, and we know what a good salary if we're going to work at a local factory or something like that. So that return to labor still shows that Group B might be somewhat profitable. It already took Group D out of the equation at negative 87, so they're actually getting negative return to their labor. So I tend to call that psychological income, for lack of a better term, is that they're doing it for the pleasure of just milking goats. Okay, so even though they're not making money, they're actually paying for that pleasure of milking goats in that situation. But the IVO ones are at 299, so I'm getting to the point where if it's that high on the return to labor on the does, that I would tend to say that they're probably going to be our most profitable group. But again, I don't know that for sure because again, it's only the end of the third quarter. So now we're going to take a look at a few other things that we'll take a look at in the way of kind of different types of whether it be costs and how much they're actually earning. So the unpaid labor cost here, we've got the unpaid labor hours that are going into each one of these operations. So the labor FTEs, these are the full-time equivalents, and this is whether it's paid or unpaid. So you can kind of see what this is. There's a little bit of difference between the unpaid labor hours and these labor FTEs. So this is unpaid only here, where the cursor is, and this is the FTEs, whether they're paid or not paid. It's all the labor that's going into the operation. So now we come to the unpaid labor earnings per hour. And so Group A, on average, they were $5.22, so not even making minimum wage. Group B depends on where you're at in the country, if they're making minimum wage or not, but at $13.73, that was the high profit group. Okay, so it might sometimes on one individual farm get into that $20 or $30 per hour, but on average, it's only about $13.73. So Group C, $4.77. Group D, here's a second thing that says that these guys are pretty high financial risk. And Group E, even though it might have the highest cost of production that we're going to get to, actually had an unpaid labor earnings per hour higher than Group D. Okay, so sometimes when you do a financial analysis, somebody might be highest on return on assets, another farm might be higher on return per labor hour, and a third farm might be higher or better on cost of production, which we'll get to here next. So when we take a look at the milk prices and milk that was sold and the prices that they actually received. So again, on average, it was 45.46 in Wisconsin. And Group E actually got 46.60, so they actually got the higher milk price. So their break-even cost, and now when we get down to a break-even cost per hundredweight, the important piece to realize is that this is for all the farms, and this is all costs included. 100% of their equity, whether the bank owns it or that farmer owns that equity, and 100% of the labor, whether they're paid or unpaid, is in this equation. Okay, so their total break even on Group B at 43.16. So they were the only group that actually got a milk price that was higher than what their break even cost was. Okay, so if we go all the way over to Group E, their total break even cost of production was $76.25. So they're actually a negative $30 per hundredweight. But they probably are less stressed because they don't think of their labor as a cost, and sometimes their equity as a cost either. And so if they were just kind of thinking that way, they would actually think that they're better than Group D, which in a sense they probably are because of the labor earnings per hour. But when you take a look at full cost of production, that's the important piece. And that's the important piece of why the industry wants us to try to do these studies. And so if you're from some of these states, like I said, California especially, but Texas, Oklahoma, Arkansas, Missouri, Kentucky, or if you're from Wisconsin and Iowa, those are the states that we're going to go after to try to do this study this next year. So don't be afraid to get a hold of Jen or I if you'd like to do this study, especially if you're more of a commercial type herd to work with it, because we are going to be looking for farms to visit this year and actually run this analysis free of charge to you guys because of a grant that we received. So the number of does per FTE labor. So this is what I want to talk about just a little bit more, because I already mentioned that benchmark that if you can sell out 400,000 pounds of milk per FTE per person, I'm tending to say I bet you're going to have a pretty profitable operation, just like Group B is, where they're selling out this 44.26. Okay, so the second benchmark I'm going to throw at you is the milk production per doe at 2,300 pounds of milk. So Group B, it's either at 2,380. But if you can sell out 400,000 pounds of milk per person and 2,300 pounds per doe, I'm suspecting you're going to have an operation that's profitable. And if you're quite a bit below that, I'm suspecting your operation's not profitable, with all costs included. So when we take a look at that, those are just kind of a few of the benchmarks that would take a look that we should probably be taking a look at for profitability analysis. So again, as we go down here to capital invested per doe, the problem is undoubtedly in Group D, trying to have make some money with having $4,700 or almost $4,800 invested on a per doe basis to try to get these does milked. Okay, so Group E at 32. So again, I think this is a pretty decent benchmark. So on average, we really weren't too bad. And sometimes a higher investment here because of the better ventilation, better feeding facilities, and things like that. Those are investments that tend to be pretty well paid for and pretty well warranted as a reason to pay for them, because we're going to get higher dry matter intakes on the does. We're going to get higher milk production. And so again, that 3,000, 3,300, I think that's a good benchmark for where the assets, the capital invested should be. When we take a look at labor costs per doe, again, that's probably more important on labor costs per hundredweight. But when you take a look at these larger farms, they're getting it down to almost $200 per doe. When we take a look at Group E at 814, it's very difficult to survive with that much labor going into it. But again, that they're hand milkers, and so that's a different culture. So with all due respect with it, we work within the resources that we have, and every farm's a little different in how they work with the resources and their thought processes and what they've got to just kind of the game that they have to play with. So the fixed cost per doe, I'm not going to spend much time with that, but that's depreciation, interest, repairs, taxes, and insurance, kind of split down through there. So I already kind of went through some of those here that are getting marked there. So when we take a look at the Iowa industry, just realize we're not Nubians. That's supposed to be a funny play on words there. But I'm going to just cross compare quickly Group B, which is the high profit group in Wisconsin, to the average in Iowa, which was just 3 producers, and all 3 tended to do quite well. So the average herd size, you'll see the difference there. So again, herd size isn't the all end all. You can actually make a pretty decent living, I think. And so when we take a look at young producers that want to get into some aspect of dairy, I wish I could get a few more of them just thinking about milking goats instead of cows. So the crop acres, when you take a look at unpaid labor earnings per hour, 1750 versus 13. So again, nothing to brag about, but certainly respectable in that cross comparison. And I do have a note there that milk price is about $3,000 of the labor return difference. So again, the milk price in Iowa was a tad bit higher than it was in Wisconsin for this group, at least. The break-even cost per hundredweight, with all costs included, including 100% of their labor, paid or unpaid, 100% of their assets, whether the bank owns it or they own it themselves, at 42.69. And so that's a good break-even cost. And so for our best producers, if they can get $43 or so a hundredweight, I think that's a pretty good milk price. But for the average, there's only about 25% of the producers that are actually able to turn a profit at that price. And so if the industry wants to know what they need to pay producers to keep them more in business, it really depends. We don't want to reward inefficiency by just giving a bigger pay price and not forcing them to be a little bit more efficient with both their labor and their assets and their feeding regime and things like that. but it's definitely something we want to take a look at of, trying to work with what within those costs. Can half of the industry survive at $40 or $46 a hundredweight? I realize on both coasts, whether it be the Vermont or New York type or California, they tend to be getting paid, more money for some of their goat milk, depending on whatever market they're actually getting put in or being put in. So net return per hundredweight equivalent, 257 versus 135. Return to all does per FTE. So a goal is always about $50,000 per FTE. So we're definitely pretty close to that. The number of does per FTE labor, 191 to 200. And so that's kind of the third benchmark that I'll mention is that when we can start to get these producers at 150 to 200 does per FTE, okay, we've got 2,300 pounds of milk and we've got 400,000 pounds of milk sold per FTE. I think that's the equation that equals profitability on a lot of these goat herds. So you'll see the pounds of milk was actually very similar per doe between the Iowa group and the Wisconsin group. When we take a look at all labor costs per doe, that 225, definitely right there in the ballpark. And so I think that's an important piece of the picture as well when we take a look at the profitability. So then we're going to start taking a look at, now that we've kind of shown the data, is that how do you take a look at, if you want to try to increase profitability in your farm, how are you going to do it? And so when we take a look at profit, when I say the word profit, I want you to think return on assets. I do not want you to think of cash flow at all because cash flow is so misleading. It really doesn't have that much of a correlation to farm profitability, even though it's used a lot for it. So the return on assets, so if you want to increase profit, we can either increase our price or we can decrease our cost, and we put that in parentheses, and that's going to be our operating profit margin. So that's the OPM. So it's kind of like if the processor gives you $1 worth of income for your milk, how many cents on that dollar are you going to save in your pocket to, for your pure profit? Okay, so if we can say an asset turnover ratio, let's just look at a couple of these down on the bottom here. So Group A on average are saving about 38 cents on the dollar for the profit margin, 11 cents on the dollar here. Group C is actually paying 14 cents on the dollar. So Group B is the only one that actually had a positive operating profit margin. Okay, and it's very difficult to have a positive return on assets if you don't have a positive operating profit margin. So the ATO is another important piece of it because you have all these assets invested on your farm. And so how long does it take to gross enough income on your farm to pay for all those assets? So if you have $1 million worth of assets and you have a gross income of 333,333, you have a asset turnover ratio of 33%. It takes 3 years for you to gross enough income to pay for all the assets on the farm. And that's actually a pretty healthy business. So if you do it in 2 years, that'd be at 50%. If it took you 4 years, it'd be a 25% asset turnover ratio. So if we look at these asset turnover ratios on Group A, on average, they were actually quite good. Group B at 39.3, Group C, okay, Group E even at 50%. So they had very positive asset turnover ratios. Their problem was that the operating profit margins were so low. Okay, so the only one with all three positive was going to be in Group B. And so if we multiply, and because these are grouped, it might not come out this way, but on any given farm, if you take the return on assets, your profit, and you have an equation that you're going to look at the operating profit margin times the asset turnover ratio, and you multiply those two things together, you will get your rate of return on assets. Okay, so those are the three big financial measures that I encourage every dairy goat producer to learn and understand what's happening on your farm. And so sometimes I'll do a financial analysis and people might get a little surprised that I'm not being, just kind of cocky by saying this, but I can tell more about what's happening financially on your farm on these two pieces of paper than you can, and you've worked on that farm for the last 20 years. Okay, so there's a lot of things we can actually work with in understanding what's going on in that farm by doing the financial analysis. So just to make sure, Jen, that we can get those questions that we ask, can we put those poll questions back up? I want to make sure we get 100% return on these correct this time. So this is kind of a pre-post test or a post-pre test. Or was that not possible? I know you mentioned
Yeah.
you got it. So let's
It
go
looks
through
like
this
it's
one
up
again.
there. Yep.
So just real quickly, they're the same two questions. Let's see what percent change we can get.
We'll see if they've been listening, Larry.
Yeah. And what do we have, 15 returns last time?
Um, yeah, I think we were that about 50% of the participants. So we'll give them a few more seconds here and then we'll close it up. Looks like we got a few more people coming in.
Yep.
Um, just just a note, if people have questions, we are nearing the probably the close, right, Larry? Another 10, 15 minutes.
Yep. Yep.
So if people have questions, go ahead and put those in the chat. So when we get to the Q&A, we can go ahead and answer those. So I'm going to go ahead and end the poll here and share those. So you're 95%, Larry. Is that good?
Yep. We got better. We definitely got better. Yeah. So
Okay.
the answer to both of them is false. And so hopefully we went through that enough with that. So. All right. So then when we take a look at that profit equation, it's a pretty, like I said, it's an important piece of it. When we take a look, let me just kind of get this done here. So when we take a look at the Vermont study, I kind of want to move to them a little bit. But one of the biggest things, I guess, when you take a look at goat farms around the area and just trying to increase their profitability, yeah, we've seen this in the dairy cow industry, is that herd health and nutrition continue and continue and continue to get better and better at both dairy goat health and also the nutrition, and just realizing those how you can up those dry matter intakes. Sometimes it's facilities, a lot of times it's better quality feed. Ventilation is a big piece of that. And so the better quality air that they actually have, the better they're going to eat and they're better going to produce for themselves as well. When you take a look at that reproduction, I tend to say is, and I saw this in Wisconsin, we did this study in '07 and 2008 as well. And I just said there's a lot of dog genetics in a lot of these goat herds. It just, there's a lot of goats out there that just do not produce very well. And we just seem to keep them around and they go from one herd and somebody realizes after 3 to 5 years that they're not making money, so they sell them to the next unsuspecting dairy goat producer. And so that whole thought process of dairy genetics, your fastest way to improve that undoubtedly is going to be with AI. I'm not saying you can't do it with buck-bred herds, but I think that's a very important piece of it. How are you going to improve that genetic? And so when you take a look at some of these low-profile, low-genetic herds and try to use the genetics, just realize it's going to take a lot of time. I tend to say I think you're better off to buy the higher genetic goats to begin with and continue to work with them and improve them as well. So financing can be challenging without a doubt. So I surveyed the agricultural lenders when I presented this to them this fall. There's about 170 of them in the room, and when I took a look at who would lend money to a dairy goat producer, and very few raised their hands, and I sadly had to say, well, I probably wouldn't either. Okay, but there are about 25% of these herds that I'd like to do a financial analysis on, figure out what they're doing, and about 25% of them I would lend to, which is better than what most lenders would say is they wouldn't lend to any of them. Okay, so there's a lot of work that we can't just expect the lenders to take the risk on us. We've got to take the risk and actually do the financial analysis, show them budgets and what we're expecting, cross compare with other people's budgets, like some of the data that I've shared with you, and kind of work with it as well. In the Wisconsin one, I think I kind of went through some of this. Again, the dependable genetics. This is kind of what we found in that 2007 and 2008 study. The tenure among those groups was actually quite low, 3 to 5 years, and then they're out of the business and somebody else came in. So milk prices back then were actually even a lot worse than they are now relative to the cost for production. But there still is probably something they could do with the milk price to increase that. But we also got to work on the efficiency side of things. So on the right here, we're actually milking goats in the Dominican Republic. I love to travel and kind of work with farmers all over the world, whether it be cows or goats, and just to try to take a look at what we can learn from them, what they can learn from us. But that milking system tends to be a pretty important piece of the picture. And if anybody has any questions on milking systems, that's actually kind of one of my fortes. And just I love working with milking systems and just how we can try to increase the efficiency through there as well. So the genetic improvements. So how do you fast track to that 2,300 pounds of milk production per doe? When you take a look at the feed prices, what I noticed in some of the studies and meeting on some of the farms is that some people don't have as good of access to quality feed as others, especially in their locale without trucking it in from a long ways away. And so that cost of production could be a little on the regional side with it as well. And again, I think it's number 4 there, labor efficiency needs to target that 150 to 200 does per FTE. So I don't care if you're a small one working half time with 75 does or 80 does, or you're a large one, working with 500 to 1,000 does. It still comes back to how many does is an FTE, a full-time equivalent managing, and how many pounds of milk are we trying to get out with that 400,000 pounds. So I think those are the big 3 benchmarks: 2,300 pounds of dough, 150 to 200 does per FTE and 400,000 pounds of milk. And if you can give me all three of those things, Jen, I think we can give them a pretty profitable operation as long as we're not too heavily invested with that. So this is our extension dairy team. So you can give us a call. You can see what the the email there is. I've got my email up there as well, so don't be afraid to email me as either. But again, I think we can open up to questions. But I just think the biggest thing is just trying to look at those benchmarks and trying to help yourself understand if you're a dairy goat producer and you feel like you're not making money, what can you do to make money? Because that tends to be the name of the game. But there is psychological income, I realize as well. But at some point in time, the bill's got to be paid.
Sounds great, Larry. Thanks for all the great information. I think this has been a big project for you, and I think it's going to continue to get bigger in the next couple of years as we look at putting more farms into the data system and seeing what it looks like um, by adding more of those farms. So, again, if you have questions, please put those in the chat. I also did put together an evaluation for today's webinar, and I included the link there in the chat. So before you log off today, please go ahead and click on that. That just helps us with future programming in the dairy goat industry. So it looks like we have maybe just a couple questions and comments here. There was one up here from the Dominica Livestock Group asking about where do they even start because they're starting from scratch.
So are you Dominican Republic Livestock Group or where are you from?
Hey, thank you for having us. We are from Dominica, which is different from the Dominican Republic. It's a little further south in the Caribbean.
Okay. All right. Well, you should
Thank,
have me
thank you
come
for
down there
clarifying.
sometime. Yeah, I appreciate that. You need to have me come down there sometime.
We would be honored.
So where do you even start? Okay, so one of the things that I would tend to say is that because we're actually starting some in the Dominican Republic as well, and they are buying some does out of California. They're not cheap to buy them, but how do you get your seed stock started in the first place? I think that's an important piece of it. And I'm always big on model farms, and so like when I work with projects like that, I would always try to set up do I have one producer that I think I can educate well enough to, and some extension people that are working with it as well, that we can come down and actually try to set up a model farm and actually have a seed stock farm that model farm, with some of our help and things like that, there's a responsibility on their part as well, is that we're not just doing it for this model farm, we're doing this for the industry of the country. And so how can we create that seed stock farm where these bucks that we're going to raise from these are actually going to go into other people's operations, or we're going to be bringing some of those does there to be bred. So the biggest thing is how do you spread the genetics as fast as you can, because you have a lot of people putting a lot of feed and a lot of resources into some very low productive, and it's not just the goats, it's the cow, a lot of the dairy cow operations around the countries as well. And so that's where we would first start, because when you start taking a look at anything to do with facilities, this, that, and the other thing, you really, you can go as cheap as you can with most of that stuff. But it's going to be the genetics. You got to get the milk out of the does. And so it's going to be nutrition, reproduction, genetics, and things like that. And if you want to have further conversations with that, like via email, don't be afraid to email me as well, and I can work with you individually on it a little bit more too.
Thank you, Larry. I look forward to that. I surely will.
And I appreciate you being on it.
Thank you.
Yeah, and it looks like there was just another comment, just specifically looking at AI and especially in goats is expensive, and realizing that. I know there's been a couple courses, at least in the Midwest, being offered in AI. I know with the American Dairy Goat Association conference this past fall, they offered an AI course. So I think if people can get involved with programs like that and be able to get trained in that area, that might help alleviate some of that. But yeah, it is a cost. But like Larry mentioned, the genetics is a big improvement there.
Yeah, and let's actually talk about that a little bit more, because I still think that's one of our biggest issues in the industry is genetics and just the capability of these. And so if I would kind of correlate that to the dairy cow industry, if I would go into the sales barn and pick out any dairy cow that some producer said this is bad production, this is this, that, or the other reason they sold it, I could bring it back into my herd, and I bet I could get 18 to 20,000 pounds of milk out of that pretty readily. It's just how it's being managed. And so when we take a look at AI being expensive, I think even though it's expensive, it's probably cheaper than the alternative, okay, to sit there for the next 15, 20 years with low producing does That's where the expense is coming in because of everything that goes into it and all the feed. Okay, it may be the cheapest thing to actually do what's most expensive now. It might be a lot cheaper in the long run. But if you can get even a model farm set up there with 50, 60 does and bring genetics into that herd and then take the bucks out because it is pretty difficult to get the AI working. I know in the Dominican Republic, we put them on the back of a motorcycle with a small tank and take them from farm to farm and things like that. That's a lot of labor and a lot of headache with that as well. But it's a big thing is you got to get yourself a seed stock farm. So any other comments or questions or anything somebody else wants to share in their perspective on it?
Yeah, others are welcome to open their mics up if they want to provide a comment that way. We can take them that way as well.
Larry, I do have one more. We are
Sure.
currently looking to import some seed stock to Dominica as well. And
Okay.
so, um, because of the distance from California, because I live in California, but so I live in just outside Los Angeles area. Um, we are looking to do something from probably more eastern part of the United States. Do we have resources in that part of the region with good farms that we could get some good seed stock from in that area?
Yeah, I think there's some pretty good seed stock. I mean, USDA did a study. They actually found that your highest genetic goats are actually in a piece of Iowa here between Kelowna, Sigourney, and Washington County, Iowa. And so I think there's a lot of Iowa seed stock that would be readily available to go that way too. So yeah, so I guess it's where kind of the cost in there, but yeah, I'd probably just go wherever you can find. And breed wise, I don't know if you'd have to really the Sonnens are kind of the breed that most people would probably try to get there, but there's other breeds as well that I think might even work better for that market. But if you're looking at more of a fluid market, it's kind of like the Sonnens are kind of our Holsteins. But we know what happens with the Holstein cows in your territory down there is that they don't hold up so well. So the Alpines might be as good of a better breed as well.
Awesome. Thank you. I look forward to having that conversation.
Yep, sounds good.
Yeah, and I would just say a comment about the genetics or the seed stock, reaching out to the American Dairy Goat Association as well, because a lot of
Yep.
those that market genetics are going to be working through the American Dairy Goat Association. And so you can find a lot of those partners and get a hold of them.
And Jen and I are actually going to be out in California, I think in early June. So maybe there's an opportunity for there. We could visit with you as well.
I'd love to. I'd be honored. Thank you, Jennifer, as well.
Yeah, and there was a comment here, of course, be careful of importing diseases and parasites as well. Um, any of those considerations. And looks like she has Sonnens in the U.S. Virgin Islands, and they do well as well.
Yeah.
So I'm not seeing any other comments, Larry. So I think we'll wrap it up here. Appreciate you giving us this great information. Like I said, it is recorded, so we will get this out on our YouTube channel so you can go back and review it. And of course, we'll be meeting again here in February 5th, talking about neonatal care of dairy goat kids. So I hope you all tune in to that one as well and look forward to seeing you again. Thank you.